How's it going, everyone? So in this video I want to explain what should be done when a given stock depreciates in value. So I'm going to be using a specific example in this video to do exactly that. So before we start, those who are new to my channel, I just want to explain that I'm using the Trading 212 platform and I invest primarily in dividend-based stocks. So for those who want to open up a new account, feel free to use the link in the description below, where you will receive a free stock worth up to £100. So on my screen, you can see I have the Trading 212 platform open, and on the view at the bottom down here, I have all the companies that I currently invest in. And so looking at the results section, this is expressed as a percentage. We can see that we have green values and we have some red values. So the account that is losing the most is HSBC. Specifically, it's the ticker symbol HSBA, which is the London Stock Exchange version of HSBC. Now throughout the week, this value has been fluctuating from sort of -10, and then it settled slightly higher to -7. So I want to talk about what actions I took while HSBC Holdings was depreciating in value. So if we look at the 1 week chart, which means that every candlestick represents a week's worth of information, from the last 2 years or so, HSBC stock has been becoming lower and lower. Now, for some people, that would be considered a red flag, given that over time the stock is decreasing. But nonetheless, let's look into the day chart, and we can see now that every single candlestick represents a day's worth of information. So looking at recent times from end of November to December, so we can see on around the 4th to 5th of December, HSBC was one of the lowest values that it's been within the last 2 years. And so the actions that I took was to simply buy more of the underlying share. So at the time when I was -10%, I had around 30 or so shares, and I pretty much doubled that value. Now, I didn't buy everything at the exact same time. I staggered, so I bought around 20 and then 10 shares subsequently. And that is just a way of minimizing the purchasing price when a stock is reducing, because there's no clear indicator how low the stock is going to be. Now, I'm not saying my strategy is the best. There's definitely much better ways of deciding when to buy stock when it's an all-time low. In addition, you really don't have to buy a stock when it's becoming lower and lower. There could well be fundamental reasons why a company is declining, and that decline will just continue to happen. So that's something you need to be very wary of and perform your own research when making such a decision. So prior to buying more shares in HSBC, I had a look through the different articles online, and the one that I focused on was from BBC. Now, recently, HSBC has been struggling in terms of reaching the same profitable values from subsequent years. So as it stands, HSBC employs over 250,000 people, and it was recently announced that there'll be a plan up to 100,000 jobs that are to be cut. So from an investment point of view, and we can see from our graph, that such information could be a reason why the stock was volatile, but you have to ask yourselves, why is a company making cuts to their staff? And so generally that just means there's less revenue that the company is making, and subsequently they make the decision to reduce their staff to cut costs. So from an investment point of view, when a company makes such a decision, of course individuals are losing their jobs, but at the same time the company is making decisions to minimize any future losses. So within this article, it also talks about how much the profit reduced, and so before tax it dropped to the 3.8 billion mark, and that was just within 3 months, so from July to September. Now, this article references the word challenging, and it talks about the environmental conditions that exist currently. So Brexit within the UK. We also have the US and China trade war that has been ongoing for the last 18 months. And then we have all the political issues within Hong Kong. So why is it important to talk about the economy within the UK, within the relationship between US and China, the political unrest within Hong Kong? Well, HSBC is a global company. They are impacted by global economics. And with all these uncertainties, HSBC is a company that is really at the center of these three main issues that cause instability. So as an investor within a given company, you have to ask yourselves, how long will such problems last for? And can a company ride such problems? Now, there's no clear answer for that question, and every single company is different. So later on in this article, it highlights some of the positives. So as mentioned above, with the 10,000 cuts in jobs, again, from an investment standpoint, it's good to see a company making decisions. If a company has less profits to distribute in the form of employees and to shareholders in the form of dividends, then a change has to be made. Unfortunately, it's always the case that the impact is forced onto the employees. But again, from an investor, it's good to see that decisions have been made. The company is trying to be proactive, although hopefully in the long run, they can start having more employees again. So on top of that, what's really interesting from this article is that the profits, when looked at a given region, and in this case, we're looking at Asia, their profits actually rose by 4%. Now, 4% is 4.7 billion. And so it's not clear on this article, but I'm assuming that's within the 3-month period. And Hong Kong is, of course, in Asia. And so it's interesting that with all the political unrest going on in Hong Kong, Asia as a whole has been profitable. So if we just imagine an ideal world where there's no political unrest in Hong Kong, the issues surrounding Brexit in terms of trading are resolved, and the US and China trade war are settled, then we can expect HSBC share prices to be on the incline once again. Now, realistically, that is not whatever happens. A company has to adapt. They have to make changes based on economical factors. So if someone was to be pessimistic with HSBC, one could argue that they haven't been resilient to the economic changes within the EU. Now, there's no statistics, but if we go back at the top of this article, it's been stated that there's going to be modifications or restructuring plans to focus on Asian operations. So to me, it sounds like the issues within Europe, whatever they are, it's not been possible for the company to adapt. Now, most likely there'll still be headquarters within the UK. The stock itself trades on the London Stock Exchange. But it's very interesting that there's more of a focus on the Asian market, which did grow by 4%. So whether you agree that HSBC should stop spending money on Western markets and focus them on Asian-based markets, the company is making decisions based on the vast amount of information that they have, and they are trying to turn around any loss in profits that has been existing for the past year or so. And so with that said, no one has a clear answer whether the likes of HSBC will improve. They've definitely been impacted by a range of economical and political issues. And so we can perform all the types of technical analysis that we've done in the past. So if you've seen some of my previous videos, we've spoken about what dividend yield means, which is just the amount of dividends paid every single year. And so if we go to Yahoo Finance, for instance, we can see that for this year, the payout, the dividend yield is at 5.65%. Now, that's actually a really nice dividend payout. It's very high, but it's not crossing the 6% mark. So go into the statistics tab, we can find the payout ratio if we scroll down. And here we're close to the 80%. Now I've discussed in previous videos what the payout ratio means, and I'll add a video on the screen now. So payouts in sort of 60% or above are considered to be more in a red zone. And so a payout ratio of 80% means that a company only has 20% of the revenue or the profits that they make that they can distribute back into the company. So the payout ratio is really high, and we saw that number earlier at the 5.65%. Now, a percentage in the 5 or even close to 6% is not a problem, but when you see a payout ratio of 80%, that is a cause for concern. So on the one hand, the company is trying to keep shareholders investing in the company. To attract investors, and primarily dividend-based investors, they want to maintain or even increase the dividend payout year over year. And to do so, if a company is not able to be profitable or increase their profits, then the payout ratio is naturally going to increase. And so, although I have been buying more of the HSBC stock, I do suspect in the future that should the company not be able to maintain profits, there will be an impact on the dividend payouts. And that's simply because we are almost 80% on the payout ratio. That is very high indeed. So going back to our graph, the reason why I personally brought some more of the stock was just to minimize the loss. So when you buy a stock at a higher price, let's just say £100, and then the stock lowers, if you buy the same quantity, you get that stock at a discount. So what happens is your stock becomes the average of those two price points. And of course, it's dependent on the number of stocks you buy each time. But let's just say you buy the equal amount. Then the average price levels out, it becomes in between those two price points. And that is, to a degree, what I ended up doing. I brought almost double. I was buying when the price was lowering. Now we can see recently the price increased a little bit. Whether that will push all the way up, it's somewhat unlikely. I wouldn't be surprised if this stock drops more and more. But one positive to take, and for those who are invested in any type of stock, December has been a period where there's been quite a lot of sell-offs. And so there are buying opportunities should you find a stock that you like and want to purchase or purchase more of. So to summarize, those who experience drops in their account, of course you have the decision to sell the stock straight away. And in some cases, if a stock is declaring bankruptcy, for instance, well, you've probably lost most of that money already. And for individuals that see red numbers in their portfolio and worry, then the ability to pick individual stocks may not be the right approach. And in future videos, I'm going to talk about alternatives, still within Trading 212, that you can take, and you don't have to focus on individual stocks if you want to minimize your risk. But for me, I pick individual-based stocks. I'm going to be expanding the types of stocks and ETFs, for instance, just to grow my portfolio even more. But in my case, when I saw a red figure on the results section, it was just a buying opportunity. And I never worry when I see prices that drop, because at the end of the day, we're still going to be receiving dividends from the likes of HSBC, and there's always a chance that the underlying asset that we brought will appreciate in value to the price we once paid or even higher. So thanks everyone for following along with my channel, and I appreciate all the new subscribers as always. So with that said, I'll see you in the next one.